Yes, a drop in the price of Bitcoin could change your life. And anyone who understands and follows this market knows there's a question lingering. Will Bitcoin never fall again? Did we miss the chance to make big profits with Bitcoin? Will the Bitcoin cycle break or not? Because with each halving, Bitcoin goes through a period of growth, then the price drops. And to date, this pattern has never been broken. To get closer to the answers, in this video, we'll look at 4 things. First, how a Bitcoin price drop could change your financial future. Second, the macro forces moving Bitcoin right now. Third, the on-chain data that shows exactly where we are in the cycle. And fourth, the off-chain indicators, from Google Trends to Altseason signals that tell us whether this rally is close to overheating or still has fuel in the tank. And don't worry if you don't know some of these terms, I promise I'll explain them in detail. That's it. If you like my content, don't forget to subscribe. Well, first part, how a Bitcoin price drop could change your financial future. If you look at Bitcoin's history, one pattern jumps out immediately. Every bull run is followed by a brutal crash. In 2014, BTC fell 86% after peaking. In 2018, another collapse of 84%. In 2022, the drop was 77%. These aren't small corrections, they're deep cycles. And if history rhymes, the next crash could easily be in the minus 65% range by 2026. Why does this matter to you? Because Bitcoin's biggest opportunities often happen after these crashes, not at the peak of the hype. So now we are in a peak cycle, and many are saying that the Bitcoin cycle will not repeat itself, but this is actually bad, because those who trust the currency have a chance to accumulate a lot during the bearish periods. But let's put numbers to it. Imagine you had invested $1,000 at the lowest point of each cycle and sold at the next peak. In 2011, your $1,000 would have turned into $7,097, a 610% return. In 2015, your $1,000 would have turned into $130,151, a 12,915% return. In 2018, your $1,000 would have turned into $21,562, a 2,056% return. If you understand this cycle, you can plan your entry points strategically, buying when fear is at its peak instead of when everyone is euphoric. That timing difference can turn an average return into life-changing gains. History doesn't guarantee the future, but it gives you a playbook. And right now, we're still in the green zone after the 2024 halving, which means the bear cycle could come in next year. The question is, will you be ready when it does? I hope so, and I'm bringing a hard analysis to help you. Keep in mind that this video isn't investment advice, and I don't think you should predict a bearish or bullish trend for Bitcoin. We won't predict anything here. Ideally, you should monitor the market and sell gradually when there are signs of a top and buy gradually when there are signs of a bottom. This way, you'll ensure good exposure to multiple points. To start our analysis of the current scenario, let's see the macro picture, because right now it's one of the biggest reasons Bitcoin still has room to run yet before entering a bear cycle. Over the past few months, one of the biggest fears in global markets was Trump's threat to slap heavy tariffs on pretty much all of America's major trading partners. But that story has been losing steam. The market has figured out it's more of a negotiation tactic than a full-blown trade war, and in practice, deals are already being signed. The most recent example came from Japan. They secured a deal with the US at just a 15% tariff, the lowest among countries with a trade surplus to America. The Japanese Prime Minister celebrated the outcome, and the package even included a multi-billion-dollar investment pledge into US projects. And it's not just Japan. Negotiations with South Korea, parts of the European Union, and other key economies have also made progress, with final tariffs coming in far below the initial threats. This has significantly reduced the risk of a global trade escalation and brought much-needed stability to markets. For Bitcoin, that matters, because when geopolitical uncertainty drops, appetite for risk assets goes up. On the monetary policy side, things are also turning more favorable. The Fed is expected to deliver its first rate cut in September, with roughly a 2/3 chance of a second cut by December. Lower rates mean cheaper borrowing, less incentive to keep money parked in cash, and more flow into higher return opportunities, like crypto. And it's not just Japan. The whole world has started to calm down since Trump apparently doesn't take his rates so seriously and always ends up in agreements because it's just a strategy to scare the markets and close good deals. The result? US stock markets are hitting record highs almost daily, and that positive momentum is spilling over into crypto. Since May, Bitcoin ETFs have been seeing steady inflows, a sign that institutional investors are still buying, not taking profits. Even more interesting, Ethereum ETFs have been growing at an even faster pace than Bitcoin's, showing that big money still believes this market has room to appreciate. In short, lighter tariffs and institutions still accumulating. That doesn't just support Bitcoin, it actively encourages further upside. And understanding this backdrop is key, especially if we want to spot when the party starts slowing down and the drop could begin. Well, for now the video is pretty simple, but let's move on to a more in-depth analysis of market data and try to discover what phase of the cycle we are in. If you line up the past market cycles side by side, a pretty clear pattern jumps out. In both 2017 and 2022, Bitcoin peaked in October. Now, that doesn't mean we're destined to repeat that exact timing. No one here has a crystal ball, but it does give us a solid reference point to work with. Right now, the black line, which represents the current cycle, is still tracking well below the 2022 peak. The orange box on the chart marks the range where I believe the top could form. It could show up earlier, maybe in September, or stretch into November, or even December, depending a lot on how the macro picture plays out, especially in the US. Historically, when Bitcoin hits that cycle peak, the aftermath isn't gentle. We're talking about roughly a year of decline, with drops of 60% to 65%. That's why a lot of smart investors are already planning partial profit taking in the second half of this year, not because they've stopped believing in Bitcoin, but because it makes sense to take some chips off the table so you can buy back in cheaper later. So, the Bitcoin cycle is a self-fulfilling prophecy. Since investors expect a dip, they'll start exiting when the first signs of a bear cycle appear, and it will happen. Another way to track this is by looking at the halving countdown. The data says the peak often happens about 750 days before the next halving. Right now, we've just stepped into that yellow zone on the timeline. That suggests there's still room for one more strong leg up. We might even see a little pause or a small dip for a couple of weeks before a final push to the top. And there's one major factor fueling this: liquidity. Since 2020, central banks around the world have been flooding the system with money. Global M2, which includes savings deposits, small-time deposits, money market funds, and more, has jumped from about $15 trillion pre-pandemic to around $22 trillion today. That's nearly 50% of the money in circulation created in just the last 5 years. This fresh capital doesn't pour into crypto instantly. It usually takes about 12 weeks to flow through. But if you overlay the global M2 data with that lag on top of Bitcoin's price, the correlation is hard to ignore. If that relationship holds, we could be looking at a target near $2,000 by late September, though a more realistic, conservative number would be closer to $15,000. You can see the same story in stablecoins. Their total market cap has been steadily climbing since early 2024. Stablecoins are like dry powder, money that can be quickly deployed into Bitcoin, Ethereum, or other crypto assets when the conditions are right. They're also becoming more important in real-world use cases like payments, remittances, and even central bank transactions, which just makes them an even stronger part of the ecosystem. The result? Bitcoin dominance has already fallen from 66% to 60% in just 1 week. That's money rotating out of BTC and into altcoins, a classic sign of broadening risk appetite. And that's one more reason why this probably isn't the final chapter of the current cycle just yet. Now let's talk about one of the most anticipated and sometimes overhyped phases of any crypto cycle, the alt season. And why? Because it helps us understand what phase of the cycle we're in. Alt season begins to appear at the end of the bull cycle because Bitcoin is so expensive that people seek other alternatives to profit and achieve results. Investors look for new Bitcoins, and we can't yet say for sure that altcoin season has begun, but there's a clear possibility that it will happen from now on. If BTC dominance drops below 60%, this probability will increase significantly. You can already feel the buzz building. The Altseason index, which measures things like how many alts are outperforming Bitcoin, changes in total market cap, trading volumes, volatility, and even social activity, is sitting in the middle range right now. That means we're not overheated, but the trend is pushing toward the blue zone that signals widespread euphoria in alts. If this trend continues, we could get there in a matter of weeks. On-chain data backs this up. Retail still hasn't piled in. And when I say on-chain, I'm talking about the data inside the blockchain, which we extract from the BTC system itself. For Bitcoin, active addresses are well below the 1.25 million highs from past cycles. Transaction counts, total volume, and fees are all far from the congestion peaks when fees spiked above $50. In other words, the average retail investor, the kind that usually floods in at the very top, isn't here yet. Ethereum's story is similar. Network activity is steady with a recent bump in transactions and volume, but fees are still low thanks to recent upgrades. That leaves plenty of room for speculative activity before things start overheating. When we look at holder behavior, we basically divide Bitcoin owners into two groups. Short-term holders, the STHs. These are coins that have been held for less than a year. Think of them as the new money that came in recently. Long-term holders, the LTHs. Coins held for more than a year. These are the veterans, the people people who have been holding through ups and downs. At market tops, what usually happens? The LTH, the experienced guys, start selling a lot to the STH who are buying at high prices. That's a sign the old hands think it's time to cash out. Right now, the data shows that's not happening. The orange line, STH, isn't spiking and the blue line isn't crashing. Translation: the big patient holders aren't dumping yet. Then we've got the hodl waves chart. This one shows how long coins have been sitting in wallets, broken down by age groups. There's one specific zone, coins held for 3 to 12 months, that explodes when the market gets super speculative. At the top of the cycle, this band can hit 80% of supply. Right now, we're nowhere close. Another bullish sign, the number of wallets holding more than 100 BTC. We call these whales. After being flat for years post-2018, this number is climbing fast. If whales are still accumulating, it's hard to argue we're at the end of the cycle. So, while we're seeing the first signs of alt season, the real fireworks could still be ahead. Bitcoin dominance and retail entry pace are the two metrics to watch. A hard break in dominance and a spike in short-term holder activity would be the signal for the altcoin market to really go vertical. Well, even in the off-chain analysis, everything indicates that we are not yet at the top of the cycle. The NUPL, which measures unrealized profit, in other words, how much profit people would have if they sold right now, is around 55%. Imagine you bought a car for $50,000 and now it's worth $80,000. Until you sell it, that gain is only on paper. In Bitcoin cycles, when NUPL reaches 75%, it means almost everyone is in profit and likely to sell, pushing prices down. We're not there yet. The Mayer multiple, which compares Bitcoin's current price to its 200-day average, is at 1.20. In the 2017 and 2021 peaks, it hit 3.0, a sign that the market had stretched too far. In the DeFi space, decentralized finance, the total value locked in projects is about $150 billion, below the $200 billion peak from the last cycle. The difference now is that the environment is more regulated and big institutional investors are getting involved, which could drive this number to new highs. Finally, the RSI, Relative Strength Index, which measures whether the price has risen too quickly and become overbought, hasn't reached the 85 level that marked the tops of 2013, 2017, and 2021. Even when it gets there, history shows it can stay elevated for weeks before a drop. Putting it all together, public interest hasn't exploded yet, prices aren't stretched, and the market isn't showing signs of full-blown euphoria. That suggests there could still be room for one more big rally before the cycle top. Closing all the information of the entire video, we're probably in the late-stage expansion, pre-top. There is still room to make money with Bitcoin, but you will probably start preparing for a bear market scenario at the end of this year and in 2026. That's it, cousins. Stay invested.